everyone, I am VAX's AI butler Little V. Today, I'll explain one of VAX's 3 core profit engines, crypto lending. Cryptocurrency lending is an innovative financial service in the digital currency space. It allows users to borrow or lend digital assets through blockchain platforms, thereby gaining liquidity or earning profits. This service is primarily executed automatically via smart contracts, eliminating the need for traditional financial intermediaries. First, I will explain the basic operational model of VAX's cryptocurrency lending. Cryptocurrency lending involves 3 parties: lenders, borrowers, and the platform. Lenders deposit idle crypto assets into the platform's liquidity pool and earn passive income based on agreed interest rates. Borrowers provide over-collateralization, typically requiring a collateral ratio of 150% or higher to obtain the desired funds. Platform uses algorithms to automatically match supply and demand, adjusting interest rates in real time to balance the market. At VAX, we provide users with decentralized smart lending services. VAX collateralized lending is the core revenue source of our lending division. On VAX, users can collateralize mainstream cryptocurrencies like BTC or ETH to borrow stablecoins or other crypto assets, gaining liquidity without selling their holdings. VAX generates revenue by charging interest on these loans. Next, Little V will explain how VAX collateralized lending generates income for VAX. How VAX collateralized lending works. Deposit collateral. Users deposit assets like BTC or ETH into the platform's smart contract, typically requiring a collateral ratio of 150 to 200%. Borrow stablecoins. Based on the collateral's value, the platform allows users to borrow a certain percentage in stablecoins, for example, collateralizing 1 BTC to borrow 50% of its value in USD. Repay and redeem. After repaying the borrowed stablecoins plus interest, users can reclaim their collateralized BTC or ETH. Risk liquidation. If the collateral value drops below the required ratio, the platform automatically liquidates the collateral to repay the debt. So, how do users deploy borrowed crypto assets to ensure sufficient returns to cover the interest? According to VAX's financial big data analysis, most users utilize borrowed assets for leveraged trading, crypto arbitrage, and cash flow investments. Next, Little V will explain how VAX's collateralized lending generates income for VAX. Let's use BTC collateralized lending as an example. Assuming 1 BTC equals 50,000 USD, the VAX platform requires a minimum collateralization ratio of 150%. A user collateralizes 1 BTC in VAX's lending pool. Based on the rules, the maximum USD they can borrow is 50,000 USD divided by 150%, or approximately 33,333 USD. VAX charges varying interest rates depending on the borrowed asset's use. For example, if the funds are used for leveraged trading, the maximum weekly interest rate is 5%, meaning the user pays roughly 20% interest over 28 days. If the user fails to pay interest on time, VAX will liquidate the collateral to protect investors' assets. So, what advantages does VAX have over traditional crypto lending platforms? Traditional platforms like Aave or MakerDAO support fewer collateral types, offer lower borrowing rates, and rely on outdated algorithms. In contrast, VAX supports a wide range of cryptocurrencies for collateralized lending and uses cutting-edge algorithms to provide users with over 380% APY, setting us apart from competitors. At VAX, retail retail investors don't need to worry about asset security. Our professional asset management team ensures safety through the following advantages. 1. Zero barrier professional service. Smart algorithms optimize deposit or borrow rates, enabling retail users to access institutional-grade strategies and participate in advanced DeFi activities like collateralized lending and flash loans with ease. 2. Dual asset protection. Over-collateralization plus real-time risk monitoring. Automatic alerts trigger when collateral ratios near danger levels, reducing liquidation risks by 60% compared to traditional platforms. 3. Yield stacking system. Our unique lend-to-mine model rewards borrowers with platform tokens, offsetting interest costs and reducing net financing costs to 0 to 3%. 4. Cross-chain flexibility. Supports 10+ mainstream chains, for example, BTC, ETH, allowing users to deploy idle assets across chains and seize opportunities anywhere. 5. Smart Advisor. Recommends optimal lending strategies based on holdings and risk appetite, preventing over-leveraging. Join VAX and maximize your asset utilization and returns.